Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today we're going to be looking at Glencore, quite a well-known company, very large. It's actually one of the largest kind of resource, they call themselves the resource company. Basically, they're a trading and mining business for various natural resources. And certain metals as well as coal. And what's interesting about this company, and it's really important to understand the context about this business before we go into the financials, which we're going to do, and stick around for that because we're also going to be talking about the share price and how that connects with the financials, or at least if we can get some hint about that. But from the last quarterly report and earnings call, a few things to note. A few of the resources are actually down year on year prior. So zinc, copper, and cobalt. Now, I'm not going to go into the details around what they're used for. You can look at that yourself and you can do that research. That's not part of this show. But there are also some other resources that are going up. So we've seen that nickel and ferrochrome are up. So think about these as important to industrial manufacturing, production of stainless steel, wiring, so huge applications for the sustainability and green technologies. So if those things are going down, then that's going to cause some supply chain issues and product development for some of those green tech businesses. So very interesting to note that. Those are the kind of products that they are kind of extracting and processing and then selling on to manufacturers. So it's worth noting that, and we're going to come on to the financials for that later on. The share price, important to note. And stick around because we're going to look at things like the market cap, the kind of dividend yield, the yield of the business as well, especially if you're interested in investment. The share price since 2011, when they floated on the stock exchange, has been up 1.28%, so pretty much flat. In the last 5 years, it's up 89%. And then the last 1 year, it's been up about 65%. So there's been a bit of a run around resources-based, mining-based businesses, and this company has been involved in that. Some news to also note, you probably noticed this in the news, they agreed to pay the US government a settlement. Some sources say $1 billion, some sources say $1.5 billion. It's a lot of money. And basically in relation to bribery and market abuse. So I thought it was interesting, on one count, they accepted that it was true. On another count, they agreed not to deny. So I thought that was quite interesting there. So we're going to go on to the finances for that later on. Don't forget to like, share, subscribe, and you'll get notification of these videos as and when we publish them. So Ted, let's share with our viewers what we've uncovered and help them kind of analyze the finances of a business like this.
Excellent. Good to see you, Moeed. Thank you very much. And hello to all of our viewers. So as Moeed mentioned, here we go. We're going to look at the financials of this business. We are looking at their annual report 2021. So there is some latest information on sort of quarterly earnings, which you can have a look at. But we're really just going to look at the kind of the main audited accounts produced. And this will give you lots of information, this document, about what they are, what they do, where they are operating. Really, they are a mining company. Some of you may not like mining companies because they're nasty and dirty and don't really fit with our kind of, our view of the world today. However, if you want to go green and you want to start building electric cars, you're going to need a lot of copper, for example. And so these mining companies are going to do very well as we move from our fossil fuels into our new ethical and sustainable world. So it's a necessity of life. We got to get used to it. Here we go. So what we're looking at here is the income statement. The income statement obviously shows their trading account. Now, quite interesting about Glencore. Glencore really nearly went bust in 2015. Those of you who've got good memories will remember that Glencore just ended up with too much debt. They were really struggling to service that debt, and they were wobbling a little bit. And fortunately, they managed an equity for debt swap. They issued shares, used that money to pay down their debt, reducing their interest. and they carry on trading. And if you'd invested at the nadir in 2015, you'd be sitting on something like a 500% return on your investment. However, you would have had a pretty squeaky bum time on the way. So what are we looking at here? So the revenue for this company, revenue here, there's the revenue up the top. We are dealing in US dollars millions, so about $204 billion of revenue. So $204 billion of revenue. That's what they are selling all of their commodities for. Now, really important concept to remember with these guys, Glencore are price takers, okay? So they don't set the price of copper, the market sets the price of copper, and they just sell it at that market price. Unlike someone like Coca-Cola, who decide on the price of a can of Coke and try and sell it for as much as possible, okay? So if you think that we are in an inflationary environment, which we are, and you think that the price of commodities is going to go up, because that's what inflation involves, then you're going to expect to see this number here going up, not because they're producing more, but because what they're producing, they can sell for more. So Moe talked about some of the prices of their commodities. Some have gone up, some have gone down, but in an inflationary environment, everything will go up. And therefore, Glencore is a really interesting company for those of you who buy into the sustained inflation story. If you're obviously a central bank governor, you're probably still peddling the oldest. It's a transitory phenomena. But for those of us like myself who buy into the fact that this is a sustained inflationary environment, then we're only going to see these numbers go up. So this increase here, this is not due necessarily to increase in production. This is due to the increase in the value of their actual sales, of the commodities that they're selling. Very, very big cost of sales. So this is the cost of all their extraction, their mining operations, etc., etc. So very, very significant. And that leaves a very, very small margin. So if you were to calculate their gross profit margin, it's not given to you on the sheet, but if you did, they're making a gross profit of about 12 billion on sales of 204 billion, which is about a 6%. So very, very tight. And that's why, so they've got very small back office admin. And then what you'll notice here is that, for example, the interest, and I'll just highlight the interest. So there's the interest expense. That's the cost of their debt. So the interest, if we actually compare that interest to their operating profit, they're making an operating profit of 10 billion. Interest is 3.5 billion or 3.4 billion. And therefore, they're able to service that debt. Now, you could argue that as we hit inflation, so interest will rise, but that shouldn't be a problem for these guys, mainly because what they're selling is going to go up in value, and also they've got a good interest cover right now. So it looks to me like their debt for equity swap, or rather the equity for debt swap back in 2015 has worked, and they've got themselves under control. Couple of other things to notice on this income statement before we leave is this line here. These are impairments. This is the write down of assets. Maybe you've been mining and you just can't find anything. You just think, you know what, forget it. We'll just write off that mine. A big hit in 2020. So 2020 pandemic, lots of bad news. When there's a lot of bad news and everyone else is reporting bad news, time to get your bad news out as well. So they'll have probably done a lot of kind of clearing out of all that old rubbish, booked themselves a nice $4 billion loss, booked a kind of a credit on the tax as a result of that loss, and they kind of cleared their way. So they're going to have a really nice, clean balance sheet now, ready for kind of exploiting all of those opportunities. And that's really the kind of, those are the big numbers. Interesting also that they have this share in associates, so they're getting some income from some non-operating income from some of their other ventures. So there is our income statement, relatively straightforward. Profitable business, $4.3 billion in profit, and we would expect to see that rise in the future. Go on to the balance sheet. Here is their balance sheet. So nothing really kind of jumping out at us on their balance sheet. They have non-current assets. Here are the non-current assets up at the top. So these non-current assets They've got lots of investments in joint ventures, so they'll have, a lot of their mines. They'll have, they'll go 50-50 on a mine, for example. Lots of property, plant, and equipment, as you'd expect. All those kind of big diggers and kind of trucks with wheels the size of houses and all that kind of stuff. And that's what they're using for their mining activities. Quite a lot of inventory. So, and this inventory isn't really a problem for us. So often we do our quick ratio. We look at their liquidity without inventories, but these inventories really not a problem, because copper you can just sell like that. It's a commodity. There's a market price for it. It's very easy to sell. Accounts receivable, pretty straightforward, and they've got a reasonable amount of cash in the bank. Cash in the bank has increased year on year, about $3.2 billion. So again, looking pretty comfortable there. On the liabilities side, the current liabilities here down the bottom, about 50 billion of current liabilities. Again, we might compare that to our current assets. So liquidity doesn't look like a problem. 60 billion of current assets, 50 billion current liabilities, easily able to pay their bills on time. And you'll notice here the debt. So the debt is this number here plus this number here, and you'll notice that in both cases that is reducing. So these guys are still reducing their debt, and their strategic aim is to continue to reduce their debt. Okay, so they're not really paying out dividends. My understanding is they're not paying out dividends, but they are trying to reduce their debt. They're trying to get that under control. They're trying to reduce it so that they don't have a repeat of 2015. I'm really very nervous about that. So it looks like they're pretty strong balance sheets. If we take the equity, the difference between the liabilities and the debt, there it is. It's about 37 billion, up from 34 billion in the previous year. So it's all looking pretty healthy. That's the balance sheet. So nothing, pretty strong balance sheet. No kind of funnies coming out of there. Now, quite interesting here, movement in equity. Now we sometimes gloss over this a little bit, but I'm going to jump down to the movement in equity. So this is what they did with their loss now, or their profits. So this year, here's the profit coming through. So the total profit is here. There's a little bit of non-controlling interests, and so most of the profit sits here in this retained earnings. And you'll notice that they're not paying out any dividends at the moment. However, we then suddenly notice that they are actually paying out dividends, and they're paying out dividends of their share premium. So that's a little bit odd. They are paying out these dividends. They're paying it out of the share premium. My understanding is that they are now they're starting to pay out dividends. They're paying down their debt. They're paying and they are looking to pay out dividends. But it's just an interesting classification there. So the retained earnings on the face of the balance sheet looks like they're not paying out dividends, but then actually they're booking it against a share premium account, which is just a little bit odd from where I'm sitting. Not something I would usually expect. Obviously, you're allowed to do that because otherwise the auditors wouldn't have signed it off. The other interesting one is in the previous year. Now, we tend to not to go back to looking at the previous year, but the loss, I just noticed this, look at this. Here's the loss for the year, but you'll notice that the loss for the shareholder is actually only about 2 billion, and that a significant amount of that loss is attributable to the non-controlling interests. So while the company books a big loss, the people who hold that loss are actually not you, the shareholder. If you are a shareholder, it's other third parties. So I thought that was quite an interesting one. So that and again, there's a they're actually making a loss on those non-controlling interests. So the controllers of the equity are actually booking some nice big profits. So I thought that was quite an interesting item to notice there. So we're going to look at the cash flow here. And as we'd expect from a company like this, they are generating a lot of cash. So here is their numbers. They're generating 8 billion, nearly 9 billion in cash. So from their operations, it's 16 billion, and then we've got this movement in working capital. So movement in working capital. The inventory has gone up, so they haven't sold it yet. Sorry, that's accounts receivable. So people who own the money has gone up. Their inventory has gone up. So they're going to collect this money in. It's just going to be a timing difference. They're going to sell this stuff. They may be just holding on to it because commodity prices are going up. So they're we're not in any hurry to sell the copper sitting in our houses because the price of copper is going up and up and up in this inflationary environment. And you'll notice here that there is an increase in the accounts payable as well. That's just good cash flow management. So quite interesting here that they are, there's a big change in their working capital. And it's had a negative effect on their cash. So we kind of probably be looking at this number here as their core operating cash flow at nearly $17 billion. So, very, very strong cash flow. And the big reason for that is this depreciation amortization. Depreciation amortization is a non-cash expense. So lots and lots of cash. In terms of their investments, so a little bit of investments, you'll notice here it is property, plant and equipment, and they're kind of offsetting that against the dividends that they receive from their associates and joint ventures. So they're getting a little bit of income in, and then they're using that to purchase property, plant and equipment. So that's all looking pretty good. And scroll down to the last page for their financing. So financing, so we just wanted to spend a little bit of time looking at this. So here we've got the proceeds from the issue of capital market notes and the repayment of capital market notes and the maturity, those three numbers together. In fact, if we take all those kind of four numbers, all of these numbers together, all the way down to about here, this is all debt. Okay, so we can kind of roll that all together, and there's a lot of debt refinancing going on, but there's also a lot of sort of debt repayment going on as well. So they are trying to repay their debt, and you'll notice here that, for example, there's the debt, the repayment of current borrowings, for example, as well. So their debt is going down. And there is the dividend that they are paying out. So they're not issuing any shares, which is good. They've done that. They did that back in 2015. It's a well-capitalized company, and they're now sitting on about $3 billion, just over $3 billion worth of cash. So things are looking pretty good. So that's kind of, that's a whistle stop tour through the accounts. Nothing really exciting going on. No sort of big red flags. Looks a pretty solid company. So I guess in terms of, if you are looking at an investment in this company, your two investments are, one, it looks, it doesn't look like it's going to go bust. It looks like it's a pretty strong balance sheet. It's trading profitably. So your questions have got to be along the lines of, what's the price? Am I going to get it at a bargain? And also, what are the future prospects? So here is the share price. We'll have a look at that, how it's been performing recently. So you'll notice here, so quite interesting. So the share price is kind of gone all the way down and all the way back up again, and all the way down, then all the way back up again. Okay, so that slightly reflects this is a cyclical business. Okay, so Glencore is a mining company. It's a cyclical business, and what happens is, the price of copper goes up. Everybody then starts mining for copper. They produce lots of copper, so there's lots of supply, and there's not so much demand, so the price goes down, and then everyone goes, oh, sorry, I'm not going to start. So they close their copper mines, and then everybody wants to buy copper, so there's no supply and more demand, and so you end up with this cyclical nature of the business, and that's kind of reflected in their share price. There is 2015. There's their kind of their nadir for their share price when it was really kind of tanking all the way down, and it has come up since then. There's the pandemic when everyone just went, oh, we're never going to use copper again, or whatever. So it's up, and it's kind of it's as high as it's ever been. The P ratio, price to earnings ratio, is about 17 times. So it's trading on a 17 times yield, and that if we sort of put that into 17 times earnings, so if we translate that into a yield, it's about a 6% yield. 6% yield, not bad. Inflation running at 8, 9, 10%. But the Bank of England's interest rate is tiddling around about 1%, for example. So you're getting a reasonable yield. You're getting a reasonable dividend yield. My personal opinion is, I don't think this is cheap, but I don't think it's expensive. but my personal opinion is this is a great play for inflation. So if you want to protect your portfolio against inflation, if you have been stung by your investment in Netflix, for example, and Kazoo and all of these kind of, jam tomorrow tech stocks, which have all just tanked, and you're just feeling a little bit sort of beaten up and wondering where to put your money, then, and I'm not saying it's not going to go down in value, but it's not going to go down a huge amount. It looks like it's a pretty solid bet, and that there's a lot of upside in this, and there's not a lot of downside. And that's my opinion, not my advice. Now, I'm not an investor in Glencore at the moment. I am an investor in similar companies. So, I don't have to buy Glencore if I'm invested in, similar companies, but it looks to me like, this is looking like a sort of, a kind of a fairly good bed, and that this company is going to kind of bounce around, in this kind of area over here. It won't be a straight line. It's not going to scare you absolutely senseless. It's not going to halve and halve again. Famous large words maybe, but then it's not going to be a multi-bagger. It's not going to double and double and double again, for example. So this is, good, solid, safe, inflation-proof part of your portfolio. And there you go, Moe. That is my personal take on Glencore.
Yeah, interesting. And of course, that last part that you mentioned there, Ted, it's all about where you think that the prices of these metals and resources are going to continue going up and up as demand and inflation is involved. So you have to kind of make that decision here. But that was very interesting. And yeah, it'll be interesting to see how the production of those metals fluctuate as the years go by, and will that be reflected in the prices? So there you have it. Love to hear your comments and thoughts on what we've shared here. So do leave a note in the comment section below. If you are interested in a particular company, whether you're selling to them or thinking about investing in them or thinking about joining them as an employee, and you would like our expert analysis on that business in terms of the fundamental financials, do leave a note in the comment section. Tell us about the company. Also give us some context as to why you're interested in the analysis of a business like this. And as a subscriber, you will get notification the moment we do publish that. So do make sure that you subscribe and hit the notification bell button as well. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next one.
Catch you later, Moe.